Welcome to My Business Matters, the Michigan Chamber podcast.
Hello, I'm Jim Holcomb, President and CEO of the Michigan Chamber of Commerce, and your podcast host today. And whether we're talking about individuals, employers, or nonprofits, taxes always seem to be top of mind for all of us. We're really pleased today to be joined by Jared Walczak. He's a senior fellow at the Tax Foundation. He has a specialty in state taxation, and he's recently worked and completed a study on what it would mean to Michigan if we instituted a graduated income tax. That's always been a recurring discussion here in Michigan, and we wanted to dive in a little bit into the policy and does it make sense or not. Jared, welcome to the podcast.
Well, thank you so much for having me.
Appreciate it. You know, the Michigan Chamber, we've always appreciated the independent research and the expertise of the Tax Foundation. I've utilized your work over the years and referenced it many times. But for our listeners, how would you describe the Tax Foundation, maybe some of the core principles of the work that you do?
Yeah, we are a nonprofit, nonpartisan tax policy research organization. Essentially, you can call us a think tank. And our focus is really on the structure of taxes at the state and local, the federal, and even now the international level. We are looking to make tax codes more competitive. We want them to be simple, neutral, transparent. We want them to be pro-growth. We want them to be stable. And we're analyzing everything through that lens and helping policymakers and the general public better understand the trade-offs associated with tax choices.
Well, the way you talk about it sounds so simple and easy. I would assume everybody just agrees. You put out your research and there they go. They say, there's the path. It doesn't seem like politics will ever enter into this discussion at all.
If only it were so easy, although I might put myself out of a job.
Yeah, exactly. Well, the Tax Foundation, I know you recently completed an objective analysis of a graduated income tax in Michigan, and you know that's currently prohibited by our state constitution. But there are people for years have been talking about this, and should Michigan pursue it or not? There's people talking about maybe a 5% tax on what they call higher earners. At any level, what were you trying to look at when you looked at this study? Did you have a premise that you were starting from when you construct a study to kind of evaluate what it would mean?
Sure. Well, we wanted to understand what the economic implications of this tax increase would be. And of course, we have a sense of that because we have the experience of many states over the years, and we have the economic literature that speaks to these issues. We know what's happened when states have raised taxes to this degree. We've seen the outmigration effects. We've seen the effects on innovation, on economic growth, on job creation, but also on wages. You look, for instance, at California, which about a decade ago substantially raised its income taxes, and there are studies showing that about 45% of the anticipated revenue from that increase just didn't materialize because people either moved or worked less or found avoidance techniques that they just weren't paying that additional amount. There was a lot of economic destruction for just over half of the revenue that was anticipated. And so when we're looking at Michigan, we're asking the question, what does the state get out of this? Obviously, there's revenue. There would be additional revenue under this proposal, but what does it do to the economy? How much does it shrink the economy? How much does it affect people's decision making? And then who does it fall on? Because I think often when we think about taxes like this, we're thinking, oh, really high earners, and maybe we don't care about those people. Maybe you and I do, but maybe people don't care about that. But I think what comes home is these are job creators. They're small business owners. They're people in your community that not only do you know and like and work with, but they're potentially your employer. They're the people who are going to invest in the community to create the new jobs, to create the higher paying jobs, and that matters.
Yeah, I was kind of joking about it earlier, but you raised a good point about how people view it and what voters care about. Certainly in today's environment, it's more of a populist environment. And so people do look at that, and a lot of people will outwardly say, I don't care about anybody who makes a lot of money or whatever they perceive to be rich. But it sounds like what you're saying is tax policy, people adapt to it, and there's an impact. I'm wondering, one, if that's true, if people really can adapt to a policy that they don't like. And then how do you model for that when you're trying to look at the impact?
Yeah, people adapt to this in a lot of ways. The one that's often the headline is migration, when people move, or what's harder to measure, when people don't move into a state, or the brain drain, when people maybe grew up in a state, graduate from universities in the state, and then go elsewhere and try and tease out How many of them did that because of taxes? How many of them did it for other reasons? One of the keys here, of course, is that you can't just ask them, did you do it for taxes? Because a lot of people will say, well, no, I did it because there was a better job and better economic opportunity elsewhere. They were hiring in another state. There was better, overall quality of life. And you ask, well, why is that? Why were the jobs being created somewhere else? Often the answer there is taxes. So sometimes it's not, I moved because of taxes directly, but I moved because there were jobs, and there were jobs there because of taxes. And then for even those who stay, obviously, if there's less income to invest, less income to use to grow your business, that's going to be significant. If we're cutting into the margin of small businesses, which employ about half of all Michiganders, then you are reducing the degree to which they can compete with out-of-state businesses that maybe have a different structure and different tax liability. You are reducing the degree to which they can expand. You're putting some downward pressure on wages. All of that has effects for people who aren't directly affected by the tax. You might say, well, it's my boss paying this tax, but your wages may be lower. The next job that you might jump to might not be there. The innovation and the investment that might create new opportunities for you and your family might be affected by this tax.
In the study that you just recently completed, what numbers were you using, or what were you modeling in Michigan? What type of tax increase are we talking about?
Yeah, so we're modeling a proposal for an additional 5% rate on top income. So you go from the 4.25% that Michigan has currently as a flat tax on all taxable income to having a 9.25% rate on high earners. It's a lot. I mean, I think what's key here is that really is a lot. Let's level set that this is highly unusual. The median top rate in the country is below 5% now. Of course, there are many states that have no income tax. There are a lot of states that have now very low rate income taxes where it's 2.5% or 3.99%, or, a lot of them are in the threes now. So Michigan used to be really on the cutting edge, having 4.25. That's no longer the case. It's still a very good tax rate. I want to say good things for this, that it is still better than average. There's a lot to be said about it. But it's actually a lot closer to the median than it used to be. Going to 9.25 puts you in really unenviable company. You're with New York. You're higher than Massachusetts. You are with California, with Hawaii. You're with Oregon. And you're also with Minnesota, or at least near. Minnesota is actually, Minnesota has the highest rates in the region. So you have to think, what does that do to us? Because every state's different, and people are willing to pay more to be in some states than in others. And this is true not just for taxes, it's true for everything. Sure. People are willing to pay ridiculous amounts, from my perspective, to live in New York City. The amount they'll pay in rent is massively more in Manhattan, New York than in Manhattan, Kansas. And that's just obviously the case. That doesn't mean that you can put unlimited rents in New York City, just like you can't put unlimited taxes in New York. But there's a different threshold that people are willing to pay. And I think one of the fears we need to have is that when you put New York City-style rates in states that don't have everything that New York has to offer, you could have more of an emptying out than you would in those states. That New York and California cannot be your models here. They're already losing people. Mm-hmm. Yeah, they're already seeing out-migration, loss of jobs, loss of economic activity compared to what they could be. But they still have a lot of built-in advantages that most of the rest of the country doesn't have. It's, other states aren't the tech capital or the finance capital of the world. Yep. And you put New York and California-style rates on Michigan, or frankly, most other states, there's a real effect.
Would you say, is there a trend one way or the other? Because you raised a good point. You read a lot of stories and people say, okay, I'm going to leave New York, I'm going to leave California, I'm going to go to Texas and Florida with no income tax, state income taxes, as I'm aware. But is Michigan an outlier in their thought about looking at this? Because, governments are always looking for money. They're looking for revenue streams. Is Michigan an outlier just even looking at it, or are most states going the other way and trying to reduce taxes?
There is a split, but most states are going the other way. 26 states have lower income tax rates now than they did in 2021. Now, that was briefly 27 because, of course, Michigan briefly had a lower rate, but it's 26 right now. So 26 states have cut their individual income tax rates in the past 5 years. a handful of states have increased them. So, there was a ballot measure in Massachusetts that increased rates for high earners. You had one in New York, not a ballot measure, but you had an increase on high earners in New York. So there are some going in that opposite direction of raising taxes. But, you sort of have New York, Maryland, Massachusetts on one side, and then you have the majority of states with an income tax, a true majority of them, red, blue, purple states alike, cutting income tax rates in recent years. So Michigan wouldn't be alone, but it would be in a very small camp that is swimming against the tide.
What do you know off the top of your head, or did you look at this in your study, like our competitive states, maybe Indiana and Ohio, and how we would stack up against them if we went to a 9.25?
Yeah, these are states that are cutting rates rapidly. Of course, Ohio just implemented a 2.75% single rate tax. And listen, you're Michigan. You do not want to be outcompeted by Ohio. You don't want to give Ohio the win. But they now have a 2.75% flat tax. When you look at other states in the Midwest and you see Indiana, Iowa, all in the threes and going down, continuing to phase those down. I mean, Indiana is on track to be below 3% pretty soon. You have all of these states that are trying to focus on more tax competitiveness, and this would move Michigan very much in the opposite direction.
Yeah, you talked about, out-migration from states. People are so mobile now, and with the ability to remote work or different working styles, it seems like we have to do everything we can to be more competitive and not put another hurdle in our way as we try to become more economically competitive in the race for jobs of today and the careers of tomorrow. Technology is changing, and a lot of those careers are high-paying jobs. You want to be hospitable so you can attract them.
That's absolutely right, and it's key for both the location of the individual employee, who can often work anywhere and may decide on factors that, frankly, are going to be a lot of things that are going to include their tax liability, but also for the businesses themselves, because businesses are also increasingly untethered. When you needed to be located where your entire workforce was available, you might have been relatively constrained because there were certain people you could only hire in certain areas with particular agglomeration effects. Now, a business can move just about anywhere because if there are some positions they can't immediately slot in there, they can hire remote. But they still have a lot of people locally. You want that business there. It's still creating jobs in your community, and their owners, their senior leadership, they are going to very much care about the individual income tax when they make those location decisions. And of course, then just thinking again about how many businesses are pass-through businesses where income is taxed on the owner's return as individual income. It's not a C corporation. That's absolutely going to be hit by this. In fact, that's one of the really big effects of this proposed tax increase is that you are taxing directly the job creators. You're taxing a lot of the small businesses that power so much of Michigan's economy.
Yeah, I want to get into that a little bit because that's a really fascinating point. I think that a lot of people don't understand. And I wonder if you can give a little background of why the impact is there. I think people all think, okay, you're a business, whether you're a two-person mom and pop shop or you're one of the largest multinational corporations, you all file corporate income taxes. But that's not true. It's how you kind of organize and how you set up your business. So can you kind of explain why small businesses would get hit?
Yeah, so the vast majority of businesses in Michigan and throughout the country are what are called pass-through businesses, and these take several forms. They're S corporations, partnerships, LLCs, a variety of different forms, all the way down, of course, to your sole proprietorships. And all of these businesses, other than C corporations, are organized in such a way that the income from those businesses passes through, that's what the term is, to the owner's returns, and it's taxed as individual income. So that's different than corporate income tax. It's different than the way that C corporations are treated. Again, this is the vast, vast majority of all businesses in the country, and they're responsible for about half of the employment in Michigan and most other states. It's over 48% of employment in Michigan is from pass-through businesses. So you are taxing essentially the returns on investment, which many of them are plowed back into that business by the owners and investors of those smaller businesses. That affects their ability to invest in new capital that can grow their business, grow their productivity, create new opportunities. It affects the wages they can pay, the hiring they can do. All of that returns to the business is going to be taxed at a higher rate under this proposed tax. And I think, again, to your point, we often think of this as just maybe a tax on high earners. We're thinking of wages or investment income, and those are real things. The investment income piece is definitely real and very volatile, but a lot of this is small business income.
Yeah, and I think a lot of people don't realize that a small business owner, that money comes in, it may look good on paper, but that's not them taking home big bags of cash every week or every month or every year. Like you said, they're taking that money, they're reinvesting into their product, their service, their employees, and strengthening the community around them. And those are the jobs we want. As you said, they're the majority of job providers here.
They really are. And, when we think in abstracts and we say tax on high earners, I think that feels very different than when you look at the local businesses that you patron every day and the owners you might know and the employers that are employing you and your friends and your family, that you don't think of them in that way. You understand that they're earning a decent return because they have a successful business, but you also know they're working really hard, and maybe more importantly for the economy, they are plowing so much of that back into growing their business, creating the new economic opportunities, creating the new job growth. Taxing all of this too aggressively, threatens to stifle that.
Yeah, and with the small business owner too, they're just taking on an immense amount of risk. They're using their personal finance to start that. And one of the areas, we talked a little bit, you made reference to out-migration. One of the things I'm concerned about is the jobs that never get created, because if you go down this road and you become less hospitable as a tax climate, the people who never come here in the first place, or that entrepreneur who never takes that step and says, I've been doing this in my garage, now I'm going to try to open a storefront, now I'm going to try to grow it. How much lost opportunity are we going to have as a state by the people that never even try because they see this hurdle in front of them?
You're absolutely right, and it's one of the harder things to measure. It's hard to know who would have come but for a tax, but there are efforts to do that. There's one particular study I like, not only because I think it's a really interesting topic, but because in this context, it actually uses Michigan as one of its sources of data in a case study. It's looking at innovation, and particularly it's measuring patent formation, which is a great measure of, how much innovation is happening in a state. And it's particularly looking at high productivity patents, those that are cited a lot, used extensively. And it uses Michigan's initial adoption of an income tax as one of its sources of data and looks at how much patent formation, particularly high-quality patent formation, declines with that because innovators went elsewhere. And that's with a relatively modest rate income tax. We see even higher effects with high-rate income taxes and with these tax increases. So we know that innovators who care about long-term tax structure and obviously are hopeful that they are going to have a product that makes them a lot of money and creates a lot of growth eventually, they are very sensitive to taxes. They might not be paying them now, but they know it's going to hit them down the line, and they make decisions around this. And then again, there's just individuals who follow the opportunities. When you think about the brain drain that a lot of the Midwest and the Great Lakes states have unfortunately suffered, it's because some of the opportunities are elsewhere. And again, if you ask those recent graduates, why did you go to another state? They might say taxes, and they might say lower cost of living, but they may well just say that's where the jobs are.
Yep.
And that again comes back to how do you ensure that the jobs are in Michigan?
Yep. Were you able to, in your study at all, quantify some real numbers? We've talked a lot about some of the impacts, but, what does it mean for jobs or wages or economic growth? Do we know if they're going up or down, or hard numbers about what this could mean? Is there a way to model that? There
is. We did a number of estimates, and we looked at the economic literature on this, looking at the high-quality studies, especially when there's a lot of studies converging on similar elasticities, which is just a sort of technical economist term for the effect and the intensity, the effect of one factor on another, so a higher tax on jobs or wages or other things. So we look at this, and based on that, we estimate a loss of about 43,000 jobs in Michigan, which is a little under 1% of the workforce. I mean, it's a meaningful number. We see a 1% reduction in wages, and that wouldn't be overnight. Wages tend to be sticky. So if something like this happens, most employers aren't going to go back to their employees and say, hey, you're getting a pay cut. What you're going to see is that wage growth slows for years, and that if a couple of years from now you look, it's going to say, hey, wages are about 1% lower than they would have been otherwise. Gross state product, basically the broad measure of your state's economy, we look at that as shrinking about $8.5 billion, and that's in some ways an understatement because, of course, this is raising revenue for the state. it's an extraction of more than $10 billion of private sector activity. And then we estimate that there'd be migration of maybe about 17,000 additional people beyond what you would have normally had, and they would bring $1.5 billion of AGI with them to those other states when they left.
Unfortunately, the picture you're painting is you go down this, and like we talked earlier in today's kind of populist mindset among many people, it's completely counterproductive. You're going to create a situation where you have fewer jobs, loss of wages, loss of economic activity. People are going to feel it more, and then keep saying tax the rich, raise more taxes, and you're just going to keep spiraling into a negative income. You're going to exacerbate the problems by continuing to go down that road.
We see this issue over and over. You look at some of the highest tax states, and they keep coming back to the well and saying, we have budget shortfalls. We need to raise taxes again and again and again. And you sort of wonder, why does this keep happening? Why is it that these already high tax states can always plead poverty, even though they're generating all this revenue, when other states that have cut taxes often are pretty comfortable? They have stable revenues. And of course, the claim here is not that a much higher tax wouldn't raise additional revenue. It will, but it will also put downward pressure on the economy. The economy will be smaller, and you'll be extracting more revenue from it. So as that happens, you're not going to get as much revenue as your proponents originally hoped. And if you grow your spending, if you grow into this, and it's not coming in quite as you wanted, and you have continued out migration, the job creation is not coming in where you want, you come back to the well. You say, well, I guess we need to raise taxes again. Or maybe when we said high earners, maybe it needs to be a little less high earners. We'll just bring that threshold down, put more people into this tax, and you just keep exacerbating the problem. That's unfortunately been the experience of a decent number of states that have doubled down on high taxes.
Well, Jared, when you were looking at the modeling, when you did this, we talked about, the jobs and the economic impact. We talked about the new rate being, a 5% higher than 9.25. What was the threshold? When does it kick in? How would, in your modeling, are high earners defined?
Yeah, we're doing it the way that the ballot measure proposes, where this is income above $500,000 for single filers, $1 million for joint filers. And of course, that's really good income. But again, that's small business income in many cases. This is income that is being plowed back into that business. Also, to the extent that it's not, to the extent it's like capital gains, investment income from higher earners and higher net worth individuals, that's a really volatile source of revenue. You have extremely good years where revenues are great. Everyone's earning in the stock market. And then you have years where that's not the case. And, just capital realizations slide dramatically. And that makes that portion of the higher tax an extremely volatile, unreliable, unstable source of revenue for the things that this is supposed to fund.
Is there any impact? I was just thinking as we're talking, I'm thinking about senior citizens, if they're planning and selling off assets, maybe getting rid of big homes that they've been in for a while, or different things with their savings. Could it impact them if they have to realize gains in a certain year?
It has that potential. When we think about the highest earners, we sometimes think of that as a class of people that are high earners for all their lives. But the reality is that a lot of people churn in and out of that status. So they may have a year or two in which they are particularly high earners because they have realized a lot of their investments, whether it's selling a house that's appreciated substantially over the years or selling investments. And they can be seemingly rich for 1 year, even though, on average, maybe they've had a middle-class lifestyle. Now, there are exclusions for some capital gains on houses. So just because your house is appreciated doesn't mean it's going to bump you into this. But yes, there will be people who have had a house that is simply worth a whole lot more. And that's maybe great news for them if they do plan to sell. But there is the potential that that could bump them up into having more than $500,000 of income in 1 year that would be subject to tax. Again, it would have to be above that exclusion. But that could happen, and that's not their ordinary income, but it could happen that year.
We talked early on about people can adapt to policy changes and tax changes. If we're talking about somebody who is really, wealthier in that high income earner stage of life or prolonged in that, how easy is it for them to avoid this tax and just move?
For some, it can be very easy. It really depends who you are. For the highest income individuals, the highest net worth individuals, they tend to be very mobile. They can go just about anywhere they want. And if you work in certain sectors, you can go just about anywhere you want. Some small business owners are a little more constrained. If you own a store, It's hard to pick up and start again somewhere else. And sometimes policymakers say, we got you. But of course, what you're doing is you're limiting the ability for them to expand. You're limiting the ability for them to grow their business, invest more in it, rather than maybe invest their returns in something elsewhere, even if they remain in the state. So some people can move relatively easily. Some, it's a lot harder. But the long-term pressure is certainly go elsewhere if you want to be successful, because this is a state that taxes success.
Yeah, we've started off this conversation talking about this has been a popular proposal in Michigan for decades. We do have the prohibition in our Constitution, so the people have to get involved, but it comes up every legislative cycle. It comes up, constantly with people looking for revenue in the state. But the picture you're painting seems to be one that very well could be damaging in Michigan if we're going to lose jobs, lose economic competitiveness, have a negative impact on wages. We already have a population problem. We want to import people and get our migration up, not out migration. It seems like there are a lot of things that people really need to take a hard look at this when they're evaluating it. It's not as simple and as easy as talking points about just tax the rich, they can afford it.
Yeah, that's absolutely right. Talking points can disguise a lot in the policy realm. The good news is that from what we've seen across the country, I think voters often do ultimately get this. You look, for instance, at Illinois, where voters rejected a proposed graduated rate income tax because they understood, well, one, that it was going to harm their economy, and two, I think they also understood that once they admitted the possibility of a graduated rate income tax, that what starts out as a tax just on high earners eventually could become a tax on middle-income taxpayers at higher rates as well.
Jared, we've covered a lot of ground in our discussion today. We've talked about economic impacts. We've talked about the impact on the individual. We've talked about, what it could mean as people adapt and the negative impacts on the state. I'm thinking what's the one thing, if you had one last thought that you want listeners to take away? You've done a great fact-based study. It's always objective. If you could summarize what the study says or what people should think about when they're evaluating the possibility of a graduated income tax, what would you tell them?
I tell them, think about the state you want to be, not just next year, but 5 years from now, 10 years from now, 20 years from now. Do you want your children to have opportunities in the state? Do you want the opportunity for people to not only make a life for themselves, but to create opportunities for others, to grow that economy? Do you want to pick winners and losers in the system like this, or do you want an opportunity to reverse some of the negative trends, to have growth in the state? To make it a place that you could spend your whole life and have everything you want in Michigan. I look at the states that have done meaningful tax reform, that have focused on tax relief or keeping their tax codes competitive, and you see the success of those states. And that's what Michigan should want. This strategy of doubling down, taxing high earners in really aggressive ways, taxing small businesses in aggressive ways, sure, it can raise some revenue, but I don't think it's going to create the state that people want for the long term.
Absolutely. I think it's a great way to look at it. We have to look at policy for what we want the outcome to be, not the short-term spending capabilities. But once again, time goes by fast. We really want to say thank you to Jared Walczak. He's a senior fellow at the Tax Foundation. He has a specialty in state taxation, and really appreciate him walking through the conversation on a graduated income tax based on data and facts. And today's takeaway for me is simple. Tax policy is never as narrow or as easy as slogans suggest. It can have sweeping, unintended consequences, and we all need to pay attention to that. Thank you to all of you for listening. Please make sure to be engaged, be educated, learn more, subscribe and like our podcast for easy notifications. And until next time, you can always go to michamber.com for policy insights and discussions.